Okay, good afternoon to those who are already online. Welcome to this now third webinar in our WHU series on the implications of COVID-19 on corporations. There's people coming in now into this room, so virtual room, of course, but let's wait another 1 or 2 minutes. So, welcome again. Before we get started, a very brief introduction from my side. So my name is Christian Andres. I'm a professor of corporate finance at WHU, the Otto Beisheim School of Management. Most of you, I guess, know that we're a business school in Germany. So I've joined WHU roughly 9 years ago. I do corporate finance, as I said, and I'm an empiricist. So my research is mostly in areas around classic topics of corporate finance, around capital structure, payout policy, but also topics at the intersection between classic corporate finance and corporate governance, a bit of executive compensation, ownership structure, family firms. So very briefly, also in terms of now my here it works. So a few organizational remarks. So we've organized this 1 hour scheduled session as a presentation. I'll first talk a little bit, 30 to 40 minutes, about the general environment, a couple of topics that we outlined initially, and afterwards we have a Q&A session. So in case you haven't used Zoom before, there's a chat button, as I mentioned, at the bottom of your screens. Use this to get in touch with other participants of the webinar. If you want to send in a question for the Q&A, which is going to be managed by our team, please use the Q&A function for questions directed towards me for the second half of this webinar, and the chat function again to discuss among yourselves. In case you have to leave, many of you are in their home office, I guess, the recording of the entire webinar will be made available to everybody later on, I guess, on YouTube. So I want to focus here on the corporate finance implications of COVID-19 or the Corona crisis. But we also need to put this a little bit into perspective because, of course, firms operate within a general economic environment. And to very briefly, again, outline what the problem is, because if we want to discuss about potential solutions to this problem, we're talking about a, well, unique type of problem that we haven't really faced, at least not to this magnitude before. So many of you have seen something or are actively monitoring this every day several times. We're talking about a pandemic here. The problem with the coronavirus, as any other pandemic, is that it spreads quickly. So the whole notion of exponential growth is something that you've probably come across many times recently, which is why many countries around the world have started to contain the virus early in this spreading process. And that's what we've discussed around the whole flattening the curve argument, because the problem is that our health systems might at some point be overwhelmed. It's not only doctors, but in particular, intensive care units are simply not designed to withstand this kind of peak pressure, which is why we needed to flatten the curve, or still need to flatten the curve. This means, again, people get infected, but get infected more slowly over time. But containing it essentially means that we need to shut down entire economies. That's the whole process of social distancing. And we're focusing, that's important to keep in mind here, on the physical business side. So brick and mortar stores, chains, whatever you're looking at, mom and pop shops, everybody's infected and affected, sorry, not infected, hopefully not, but affected by the spread of the virus. These businesses are closed down. So we are talking here about an exogenous shock. It's not something, I'll talk about some similarities and important differences to other crises we've seen in the past in a moment. This is not endogenously from within businesses, it's an exogenous shock. And it is something that poses what we call a systemic risk. Many of you might have heard about systemic risks in connection with the financial crisis. It is an extreme risk that has the potential threat of affecting not only a certain industry, but the entire system, entire economic system. And what's also important about systemic risks is that they affect everybody and they are very hard to hedge. Risk management and hedging is, of course, an important part of corporate finance also. So if you look at an airline that wants to, we've seen other crises, the oil crisis, for example, in the 1970s before. If you want to hedge your kerosene exposure, that's possible. There's all sorts of futures and other ways to hedge oil exposure. That's very hard in this case. There's no perfect hedge, not even imperfect hedges. So it affects everybody, but it's important to keep in mind that it does not affect everybody similarly. So we'll seeing restaurants, of course, closing, travel, and so on. So physical entertainment, football clubs cannot admit any, cannot host games and admit people to stadiums. They have suffered significantly. On the other hand, everything around home delivery, Amazon by now has hired a 6-digit amount of workers. Everybody around, well, digital facilitation, Zoom, for example, is a company that basically has seen unprecedented growth in users over the past couple of weeks, but also other kinds of businesses that are maybe not well, in the middle of your radar. That's one Peloton, for example, let's say with fitness studios being closed down, they deliver your spinning bike to your home. They're almost at an all-time high. So everybody's affected, but differently in different industries. So it is very different from anything we've seen before. Also, what's important to keep in mind, COVID-19 is not a war. Emmanuel Macron and others have called it a war against Corona. Keep in mind, this was to convince everybody that maintaining social distancing is really important, but it's not a war, it's a pandemic. And a war would mean infrastructure is destroyed that needs to be rebuilt. That's not the case here. But what is really important about this pandemic aspect is its speed. And I'm going to get back to that in a moment. The financial crisis, which is for most of you, I guess, the other big crisis that you experienced in your lifetime just 10 years ago, was something entirely different. It was caused mainly by asymmetric information and also mismanagement. So in a nutshell, originating in the US housing industry or the financial industry on housing products, where loans were repackaged and repackaged and repackaged until in the end of the day, no one really knew what they were buying, and of course, openly mismanagement. So it originated in the financial industry, which is why we call it the financial crisis, and in the first step at least, caused a financial crisis. What is important here is that at the get-go, it was confined to a single industry, and more importantly, to the large players in this industry. You probably all remember Bear Stearns, Lehman Brothers, and other large banks that of course still exist today. They were affected, which makes it comparatively easy to manage from a policy perspective, because you need to get these people together in a room. You simplified, hand them bailout checks, and the core of the crisis, at least, is dealt with. Sure, we had other ripple effects, the European sovereign debt crisis in 2012-13 that went on, the real estate crisis in southern parts of Europe, around the world. So it was a crisis, started in a single industry, was first limited to this industry, but went on for years and years and years. When we look at Corona or COVID-19, we're looking at unprecedented speed. So what you can see here is an excerpt from an article published in the New York Times last week, where two researchers looked at electricity usage in Europe, Italy, and the United States. Why do we look at that? Because right now there's so much uncertainty in markets, also among economists, because when we are being asked how severe the economic impact is, well, basically we base this on models. And our models are not calibrated to this kind of shock. In particular, when we talk about recessions, and recessions are formally recognized as such, this usually happens with a rather long delay. Some recessions are only formally recognized as such once the recession is over. What in the past has been identified as a pretty good indicator for severe recessions is electricity usage. Why? Because as economic activity increases or decreases, electricity usage decreases. So you can see here for Italy, there's been a decrease of up to 25% in, this cannot be related one-to-one to changes in GDP, of course, but we've seen an extreme decrease in economic activity in Italy. Europe and the US, even though, well, hopefully are not affected to the same order of magnitude as Italy, but they are lagging. So that's probably the looming potential downside. If you see Italy as a lower bound, what is still to come for the rest of Europe and the US in the next couple of weeks. But also, some of you might have seen this title page that you can see here from the New York Times on March 27th. So in case you can't see it, these orange yellow bars are initial claims for unemployment benefits in the US. The shaded area in the middle here is the number of jobless unemployment claims in the financial crisis, which was the historic height, which was in a single week, 670,000, I think. Then in late March, we had more than 3 million related to 670,000 in a single week. By last Friday, 16.78 million US citizens had filed for unemployment benefits in the US. To put this in perspective, over the entire financial crisis, so originating from the financial industry and then moving on to other Main Street businesses, the overall maximum was 10 million unemployed. The US is currently looking at the lowest share since World War II of adults employed. This is all very grim, of course, but the good news is, in comparison to earlier crises, many of these employees are not laid off formally, but they are furloughed. Furloughed basically means that they do not receive salary, which means they're entitled to unemployment benefits, but they still get health coverage. Okay? So in a sense, you put them out of work to be able to quickly get them back. So furloughed, that's the positive aspect about it, if you want to get anything positive out of it. So where do we stand there? We have an economic downturn that is definitely deep and fast, and different industries are hit with different intensity. But what is special here in comparison to the financial crisis, for example, is that it's not a big firm problem, but it's a small firm problem. Small firms are hit the hardest for several reasons. Well, firstly, you can't typically, if you're a mom and pop shop owner, you're not diversified. You're not diversified geographically. Even if you have a shop in Frankfurt, maybe you have another one in Wiesbaden or somewhere in the Rhine area. Right? And secondly, you're not really diversified in terms of a product portfolio, right? You're running a shop, right? That's it. If this shop is now closed down, your entire revenue stream is over. And basically, many of these small businesses weren't relying on online sales very much. That's something that they now are in the process of building, some more, other less successfully. And sometimes there's, of course, products that are not well suited for an online business. If you want to sell ice cream, sure, you can do home delivery, but in a very, very restricted geographical area, of course. Again, everything sounds so negative, but there is, in comparison to the financial crisis, which was this slow-moving train wreck, there is a silver lining here. I'm not an epidemiologist or a virologist, but as far as my reading is concerned, a vaccine is expected for early 2021. And even before a vaccine, we will get probably medication that helps mitigate these effects. So ideally, if you could basically bring an entire economy to the standstill on the drawing board, we would put everything in hibernation mode, hiatus, and then once the vaccine is there, or at least the medication, everything is back to full steam. The question, of course, and this is something where every single day we get new information, new estimates, how quickly we will be able to return to normal. This, of course, depends very much on the question of how long this lockdown will last. Last night, France extended the entire lockdown of the economy until May 11th. There were some positive signs from Austria last week. Germany will be debating a path towards normality tomorrow. So that's something that's right now very hard to assess, because in addition to the extreme speed that we've never seen before, there's a lot of uncertainty how long these extreme measures will need to be maintained. Overall, economists are discussing whether this will be a V-shape, which means we go down quick, but we go up quick, or a U-shape, which would be a recession, so we drag on, then we move back up, or the L, that's the dreaded scenario, which means we will return to a normality, but this normality is a new normality. In particular, it's a normality with much lower growth rates. Question, where do we stand? I think by now for a V, the chances are very, very slim, because we see that the lockdowns and everything that's connected to these lockdowns will last for a little longer. My personal money would be on a, well, skinny U, let's say, so not an extended recession over longer time periods. If we can be able to, if we're able to get medication or a vaccine relatively quickly by the end of 2020, maybe, probably something like a U. But exactly this uncertainty is something that market participants, and at the end of the day, all of us who participate in financial markets, have a hard time really quantifying. What you can see here is the S&P 500, very broad US index, where you see moved from an up of almost 3,500 to 2,500. And for those who are in Germany here, the DAX 30, very broad German index, that moved from close to 14,000 points to 8,500 points. So by and large, roughly like 40% changes within only weeks in the value of these companies. We've seen an upward bounce again, which has partly to do with the measures that central banks, and there we are in the realm of monetary policy, have adopted. So central banks have reacted quickly. The US Federal Reserve has reduced interest rates twice. This is kind of the playbook approach, the classic approach. If you want to cause an economic stimulus, you will lower the interest rate, right? Because then not only banks, but participants in the entire economy can get debt financing at cheaper rates. The problem is, in the euro area, we're still in the phasing out period. We haven't really never reached it, of the financial crisis. So in other words, we were looking at zero or even negative interest rates in the euro area. And in addition to setting the interest rates, both and other central banks around the world as well, both the Fed and the ECB engage in what we call quantitative easing. In the old days, before the financial crisis, the main role of a central bank was restricted to price stability. The Fed always had a somewhat broader mandate, which was also to encourage, foster economic growth. But what central banks have not done in the past is to directly act as investors. But that's essentially what central banks are doing these days. So quantitative easing means it's not only government bonds that are bought, not by investors, but by the central banks, but also firms' bonds. So if we have firms that have access to the public debt markets and they issue bonds, so debt in the company, the ECB and the Fed buys these bonds. And they've basically made clear the Mario Draghi equivalent of whatever it takes. There's no limit really on quantitative easing. We will buy these bonds. What is special now in comparison, because that's something that already happened after the financial crisis, here is that even lower rated debt. So the ECB has always restricted its bond purchase program to investment grade. This is if you take Standard & Poor's rating of BBB or better, they're now buying, also in the US, junk bonds or sub-investment grade, or even ETFs that buy bonds in these sub-investment grade markets. So in addition, we have even lower rated debt that is accepted as a collateral. So basically the ECB and the Fed are doing whatever it takes. They're taking everything they can to supply the market with liquidity. On the other hand, this is both a bit, because this is not supposed to be all econ, a bit summarized here, but governments have done the same. So the monetary policy equivalent of fiscal policy is to take out the really big bazooka. So in the US, there's been the $2 trillion CARES Act, direct payments to households, funding of unemployment benefits. But really special here is this Main Street Lending program, the MSLP, which is designed to solve the problem that it's particular small businesses who have problems with, well, getting revenue, and therefore, if your cost is still running, of simply running into a liquidity crunch. Germany, an entire package of roughly 500 billion euros, also aimed at providing liquidity. We've had a state guarantee, and German politicians have gone on record and have said, basically, we're looking at unlimited cash. The tricky part here is, of course, telling apart those firms who are healthy firms, and that's, of course, the vast majority of firms, without Corona, and supplying them with cash. The European Union last Thursday, before the Easter break, also agreed on a 500 billion emergency rescue package. So the problem that we have mostly in financial markets, there's sufficient liquidity, right? The monetary policy and governments trying to make sure that there's as much liquidity as needed coming to the market. But we are, and this is something that to many seems a bit counterintuitive, if there's so much liquidity, reassuring of societies, companies, consumers that everything is under control, we've seen an extreme increase in volatility. So this is the VIX index, which is a broad volatility index. And we're looking, if you look at this in 2020 now, we are looking at uncertainty and therefore changes in prices in the market, because as new information comes to the market, prices are updated, right? And this happens really, really fast always. But here, the magnitude of these price changes is something that is far bigger than what we can call with hindsight the internet bubble, the burst of this bubble, 9/11. We are in basically the same area that we were during the financial crisis. So, and what happens in the case of high uncertainty is that people pull out of everything that even vaguely smells like risk. So they return to the safe haven. The safe haven, what you can see here, are government yields for US treasuries, 10-year maturity at the top, and German treasuries, 10-year maturity at the bottom. So can't really compare these rates because one is US dollar denominated, the other is euro denominated, but they're both the de facto safe havens in their respective currencies. So in the US, we're looking at an all-time low yield-wise, and in Germany, well, reached the all-time low a couple of weeks ago, but still, rates are in negative territory. Again, this is something that seems very strange to many. The German government, if you buy their bonds, so if you give them a loan, you'll have to pay them. So they accept this loan, right? There's a couple of cases where in Denmark, you've seen that homeowners, you take out a mortgage on your home, right? You buy a house, and it's not only that you need to repay the loan, but you get money. You don't pay interest, you get money for taking out the loan. That's what we get with negative interest rates. So banks are so keen to get money out into the economy that they offer you a negative interest rate, because they would need to pay a negative interest rate if they deposit their money with the central bank. That's what's wanted. The problem in the mid to long run is we are, central banks are running out of firepower, and we might be running into what is called a liquidity trap. Because what's the trap here? There's so much liquidity. This term in econ goes back to John Maynard Keynes in the 1930s, where this was still an abstract phenomenon, where interest rates are so low that you don't have any incentive to invest into these kinds of financial products, because you get even a negative return to this extreme, right? This means you looking basically at a flat horizontal demand curve for these products, and even increasing interest rates a little bit doesn't change anything in terms of demand for these bonds, because people can still take the cash and put it on site. Cash basically has a return of zero, right? If you take banknotes under your pillow, you get a return of zero. If you deposit it in financial products, you might get a negative return. Secondly, a problem we might, or we are already facing to some extent, is also a kind of liquidity trap, but that's my interpretation of a liquidity trap. The term, again, is a term coined by Keynes. It seems like at first sight maybe to you, well, if there's so much money, if central banks are even buying corporate bonds, they're pumping a lot of cash into the economy, governments through fiscal policy pump cash into the economy, these markets must be extremely liquid. They're not. Try buying and selling a corporate bond. This is even something that we saw after the financial crisis, where when large companies tapped the public bond market, they would issue a bond and the ECB would buy it straight away. So you couldn't trade this bond because the ECB would hold it until maturity. And that's something we see also today for even large German companies. There's almost no liquidity in the bond market because the ECB is soaking out all of this liquidity out of the market, which means that even minor trades can have relatively big price impacts. But by and large, this market works. Debt markets, so this was the government bond market, Corporations issue, of course, corporate debt. What you can see here is the yield of BBB rated, which is investment grade rated, but just investment grade, US corporate debt. This went down significantly until a couple of weeks it exploded. That's this flight to safety. Again, even if you are a large company and debt is safer than equity, for sure, right? If a company, even if it files for bankruptcy, you are first in the pecking order. Equity holders don't get anything usually at the end of the day, but you get whatever is left as a debt holder. But it's still a risk that what you get out of this company is not what you gave them initially. So it's a risky asset, and yields exploded until we've really seen central banks acting in concert to the extent that they opened the floodgates, pumped so much liquidity that this effect was successfully mitigated recent days. The big problem is, as mentioned before, for small companies, because small companies do not have access to the public debt market. Late March, a German association of family businesses, die Familienunternehmer, ran a survey among its members, and they basically said 5% of them, we don't have sufficient liquidity for more than 2 weeks. 28% said, well, something up to 8 weeks we can shoulder, but then we're running out of cash. 26% up to 3 months. If you do the math and add these three numbers up, we're talking more than 50% of all companies. We are now 1 month, at least in the case of Germany, in Italy more than a month, into this entire lockdown. They'll be running out of cash because they're still cost running, and the, well, rainy day money put aside is going to be left only for a few firms for a longer time period. So governments are well aware of that, and they've acted, but they didn't really act fast enough. This is not to be understood as a critique of governments. It's exactly the right direction we're taking, but it's slow. There's an excerpt here from a German newspaper here where a large state, North Rhine-Westphalia, stopped payouts of these direct help loans to companies because of fraudulent websites, scraping information of individual firms applying for these loans, and in the end would have received money onto their accounts while they're not the real firm, right? So that's fraud. And of course, these cases need to be solved, and we need to make sure that there's not large-scale fraud going on. But to be honest, there is going to be some firms who were in financial difficulties before, who will apply for a loan and will get it even though it's not really justified. But to be honest, that's the cost we need to bear. We need to be really fast, even if it means granting loans to companies who will never repay it. Otherwise, if we really are strict in terms of looking at the documentation, screening it, and that's going to be too late for most companies. The same problem applies to the US, and governments have changed this. So basically, governments don't directly grant loans, right? But governments typically have banks. In the case of Germany, this would be the KfW, the Kreditanstalt für Wiederaufbau. But even KfW does not directly grant loans. They're using, and the same principle is how it's set up in the US, they basically use local commercial banks as a conduit. So if you want to get one of these loans as a mom and pop shop in Germany, you walk into your Sparkasse, a Deutsche Bank, and so on. The way this, and this is not unique to this situation, this is how government loans, KfW loans, are dissipated into the economy. Historically, what you've always done here is to have the commercial bank, that's where the expertise lies, they have a business relationship, but they need to have some skin in the game. Otherwise, they would just grant loans without any losses on their side. You have a moral hazard problem, right? So this was the risk taken by KfW was always limited to something like 50%. They've initially gone to 80%, then 90%, but this was still not fast enough because the usual banks are also concerned. You can't really blame banks for doing their due diligence here because the usual risk processes are in place. They need to be, because the bank otherwise also faces a risk of being belly up in a couple of weeks if we see a large proportion of defaulting loans here. So what was announced last week is that for small loans up to 3 million euros, there's not going to be any risk assessment of KfW's side, and they're going to take the full risk onto their books. It's the right fix, but again, it takes too long. It was announced last week, firms can apply for funding from tomorrow onwards. I want to go into detail with regards to the Main Street lending problem, but it's just along the same lines. Right measures taken, it's not implemented yet, but the government is going to assume 95%, that's the plan currently being discussed in the US, of this risk. So the big cash crunch, that's something we really need to mitigate for small companies, because small businesses are part of the supply chain also of large companies, and we must not lose these firms that are still healthy here. The good news is, for large companies, we are in a situation that is relatively comfortable. We have working bond markets, plus large companies have over the past 10 years built up relatively high cash reserves. What you can see here is the ratio of cash to net assets for US companies without financials and utilities. And this is so it measures as a proportion of your assets, how much do you hold in cash? That's a ratio that has historically hovered at around 6 to 8%. And it's something that's costly, right? Because if you are a shareholder of a company, an equity holder or a debt holder, you want your money to be put to productive use. You want to get a return on your investment. If it's just cash held as a safety net, it doesn't yield anything, maybe 1% if it's invested. So holding cash is costly, but companies have really buffered up their cash pillow. In the early 2000s, this was a reaction to a more uncertain business environment due to the digitalization, the internet. Then 9/11 came, jumped up to 15%. And then shortly before the financial crisis, people thought, well, we've adjusted to this new normal. We'll move down to 6 to 8%. But then the financial crisis hit. And companies, again, put more money into this safety net. And it's since then hovering at around 14, 15%, which means large companies are in a comparatively favorable situation. Even firms in relatively risky businesses these days. So there's a large US cruise line operator who successfully placed a $4 billion bond 2 weeks ago. Public bond markets work. The problem is, another problem in this context is, some of you might have witnessed that over the past 10 years we're basically looking at a 10 years since the financial crisis streak of increased profitability for companies. So companies have increased their payouts significantly. So what you can see here in blue is the aggregate amount for US companies distributed as dividends, and in gray as repurchases. So both dividends and repurchases are payments to equity holders, where you reward your equity holders for holding a risky claim, right? Risk-return relationship, as we discuss in all our programs, we've got a couple of alums here. High risk means high return. Equity is riskier than debt. You need to get higher returns. One form of rewarding is dividends, the other capital gains. And we've reached record highs. Why is this potentially problematic? Mostly because dividends tend to be very sticky. What does this mean? This is behavioral finance. There's no formal rational model for that, but we call these Lindner type payoff structures because a guy called John Lindner ran a survey in the 1950s, repeated many times, last in 2005, still holds true. And what he basically asked is, managers, how do you set the dividend? And some very common structures came out of this. And one of them is that managers believe firms should have something like a stable long-term payout ratio, which would be, for example, something like 50% of whatever our earnings are is what we want to distribute to our shareholders. And what is important here is that the focus is on the change in payouts, not so much the level. Rationally, this does not make a lot of sense because paying a $2 dividend, in my example here, is paying a $2 dividend. But it's a big deal if last year's dividend was just $1, but it's not a big deal if last year's dividend was $2. Because what we have is basically a signaling equilibrium between the market and firms. If firms set their dividends, they want to smooth the dividend path. So if you take my previous example, 50% payout, your earnings were 2, and you were on target, your dividend was 1. Let's say your earnings jumped to 4. You will not increase the dividend. 50% of 4 would be 2, but you would increase it to maybe 125. If in 2 years' time, your earnings were still 4, you would increase it to 150 because you don't want to reverse because of the strong signal this sends to the market that your outlook for the future is not as rosy as you thought. Repurchases, on the other hand, are a much more flexible measure of paying money out. Why is this a problem? One example here, Bayer, extremely textbook example of Lindner type payoff policy, you smooth changes in earnings. It is a problem because in these high times of uncertainty, firms have an incentive to signal financial strength to the market. The market is concerned. If I'm now Daimler and I need liquidity, I need to issue a couple of bonds, I want to show confidence. I want to signal to the market, everything's fine. We're in difficulties right now. It's a strong shock. We're good. We can pay the dividend we planned for. The problem is we do not know how long this lockdown will last and how extensive the recession will be. The ECB has therefore recommended banks, but only banks, who's under the supervision of the ECB, to not pay dividends and not buy back shares until October. Problem is many other and most European banks follow. Swiss banks have done the same recommendation in the US. Problem is most manufacturing firms will still announce to pay dividend to signal strength to the market. And that's what they need to do in these times of uncertainty. But these payouts could really backfire big time if something unfortunate happens and these lockdowns are extended throughout the summer. I think at these times it's also our role as academics to give a bit of policy advice. And the obvious one here is just ban dividends. Don't recommend banks not to pay dividends and don't limit this to banks. Just don't allow anybody to pay dividends for the next 6 months. If we have such a signaling equilibrium and you're not allowed to pay to use the signal, there is nothing happening, right? Finally, one aspect I want to keep really short, and it's not the problem right now, but potentially in a couple of years, because the cure right now is unlimited liquidity, and it is exactly the right cure. The problem is we are potentially running into a problem of over-indebtedness in a couple of years. Even without COVID-19, what you can see here is that firms levered up significantly. So the aggregate amount of non-financial bonds outstanding in the mid-2000s, we're talking 3-4 trillion. We've reached 14 trillion by now. Even in the US, if you also take financials into account, the 4.8 is 2017 for non-financials, we're looking at 10 trillion of debt. Debt is a limited maturity-wise claim, right? So you need to roll it over. You need to renew this bond. And there's roughly 2 trillion coming to the market in 2020 to 2022 annually that need to be renewed. On top of that, we have the increased liquidity demand. And I want to be devil's advocate, but there's a high proportion of companies, in particular in developing emerging markets, that were already leveraged really highly. Interest coverage ratio basically shows you how many times based on your EBIT or EBITDA can you pay interest. This is based on EBIT here. But almost a quarter of them have this interest coverage ratio of less than 1.5, which means based on their EBIT, they can pay interest and another 50% maybe of interest. But if there's a severe shock to their revenue, and we're talking about industries where 60, 70, up to 100% of the revenue is lost, these firms are in severe, severe trouble. But that's not the problem to solve of over-indebtedness right now, but it's a problem we're gonna have to deal with in a couple of years. To wrap this up, the big problem we have is uncertainty. It is really at historical heights. And therefore, when you look at the valuation changes in equity, stock market indices going down, for those of you who've participated in a financial literacy course or so, you've covered the basic of what we call a DCF valuation, right? Discounted cash flow. That's the Warren Buffett approach. You buy a firm to buy into a stream of income. So you take expected future cash flows and discount them to today. That's the present value of the price. Sure, even if we have an extended recession over 2-3 years, we might have limited cash flows for the next 2-3 years. But in the long run, and equity is a very long claim, these effects should be relatively mild. Certainly not 40% on average. So the problem we have is the discount rate. This shoots up right now. That's what I mean by denominator problem. Providing liquidity, I talked about this. Recommendation would be that payouts should be restricted in 2020. When we talk about a Marshall Plan, that's right in the mid to long term, but that's right now a bit too early. I read today that car manufacturers are asking for an additional stimulus to incentivize people to buy cars. Yes, sure, but if car dealerships are closed, this is not a problem to solve right now. In the mid to long run, firms, as mentioned before, risk being over-leveraged. And the only way to really fix this is to make equity investments into companies more attractive. What governments can do here is, well, foster growth through regulation that's equity friendly of equity issues, but also to lower taxes on dividends and capital gains, because then you make it more attractive to supply equity capital to companies. Because we have a two-sided problem here, right? Profitability is down. The bottom line of your profitability, of your profit and loss statement, is going to the equity of your balance sheet, right? So you have equity that shrinks in a recession, plus we have extreme liquidity problems right now that are solved by using debt. So we have even a lever to the lever of leverage, right? And firms end up with extremely high debt ratios. And that's something we're gonna have to solve in the years to come. Okay, this should be it. I want to keep it to something like maximum 40 minutes. If you have questions, Rebecca and some others are collecting those.
Thank you very much, Christian, for your presentation and for the insights you shared. There came a few questions, and you are welcome to write questions while Christian answers some of them. And I would start into one question regarding the global monetary measures. Basically, countries now spend a lot of money, and what do you think the impact on inflation and debts are going to be? And of course, not every debt can be paid back in the end. What do you think about that? And could you share?
Absolutely, absolutely. That's a great question. I mean, the issue about inflation, that's something, frankly speaking, that I've been telling 10 years ago, and for 10 years I was wrong because inflation never really picked up. But at the end of the day, this money needs to go somewhere. I mean, some people argue that even if we don't see inflation in the usual basket, that we have asset inflation in the housing market, for example, that this is where all of this money ended up. But at the end of the day, someone also needs to pay for everything that we're spending now, right? This is going to be taxpayers. And many people are going to be looking at relatively high debt levels already. So, and that's basically also the greater question of how we will emerge from this crisis, because people have lost income. If you take GDP as a measure of income of the entire economy, there's estimates today that in the Eurozone, GDP will go down by 8%. So this is simply less income that people have. And we're bridging this income by debt. So people will be looking at high levels of debt, and this, as research shows, also affects their behavior. So the debt change, the debt increase will also have implications on their spending. And what we also have as a third effect is a wealth effect, right? This is probably the least of these. So the direct income effect, the high leverage that's needs to be shouldered, and then potentially an assets risk. If you're invested heavily into the stock market and so on, your value declined of these holdings, right? That's a difficult situation. And as outlined before, yes, many companies, and this is what in particular small firm shop owners argue right now, these loans are not really, even this KfW Schnellkredit is not really helpful for us because we'll have to repay it at some point. That's right, absolutely. And therefore, my recommendation earlier would be for governments to incentivize investors to supply equity, because if you had something like an optimal debt equity mix, you can only return to this in the mid to long run if you infuse new equity, because we've reached levels of debt that are simply too high indeed.
One question building up on that is if it's really possible to incentivize debt holders to switch to equity. Considering the current economic and financial situation and the possibility that other pandemics might happen, uncertainty among investors will increase, won't it?
Absolutely, and that's what we're seeing. Uncertainty among investors has skyrocketed, and government's question before, monetary and fiscal policy, there's only so much governments and the central bank can do. At the end of the day, this uncertainty it's a biological problem, and there's not going to be a monetary or a fiscal solution to this biological problem. There's only a biological solution, and this is what is always a bit concerning, I would even say, around this discussion that we're now seeing in some of Europe and the US in particular. If there's no credibility in public administration, and that's a bit of the problem in the US, because some of what the Trump administration does contradicts what other parts of the administration does. If there's no certainty to the extent that people trust in those who act, and by those who act I mean both central banks and also governments, even lifting formal lockdowns will not really help, because then people will lock themselves down if they're still concerned that they might get infected by a virus that the government doesn't have under control. So absolutely, we first need to get the uncertainty out of the market, and the uncertainty out of our world. So not only financial markets, and the only cure there is really a vaccine. Absolutely. Right now, buying equity is almost, or selling equity from a firm's perspective is almost impossible. Some firms were successful over the past 2 to 3 weeks. But in the short run, I fully agree that's something that's going to be more or less impossible.
So this, Christian, is a question with regards to the V, U, or L kind of recovery path. So what, in your opinion, or from your expertise, what are the watch points for us to better know what kind of recovery is going to happen? So how will we know?
Well, if I knew for sure, I would probably end up being really rich. So I was afraid I was betting on a V. I entered the market too early. But you're asking for indicators. So what's really important are, as I said, the main problem is uncertainty right now, and the problem is that this uncertainty is out of control right now. So we're trying to control it through these lockdowns. So if you ask for specific metrics, they wouldn't be financial metrics, whether we get a V or U shape. They would mostly be the question of how long will there be a lockdown. So one important metric that everybody's looking at is this inflection point, where the basically number of new infections in a country go down, and then secondly, we'll need to be looking for a plateau point, basically, and that's in epidemiology. Again, I'm not an epidemiologist, but following this would be this literature where 90% of the overall infections have been reached, and then it's increasing only very slowly. So this inflection point is really important. I think even in Italy these days, this is where people get back confidence, even if the situation is really dire in Italy right now. But seeing an inflection point where infections go down, this basically reassures people we have something under control. And then, of course, the next step is we need to get a plan to come out of these lockdowns, because the longer these lockdowns last, the more severe the economic implications are going to be. Absolutely. And here again, it's very hard to even get a kind of formula. If we lock down for 3 months, we will get X% GDP, because we've never seen a crisis like this. And what you do in modeling is basically you fit a model based on past data. But as outlined before, we're talking about a very different kind of magnitude and speed of crisis that we haven't seen before. So it's extremely hard. One metric, again, would be the epidemiology metrics.
And a second question to you with regards to the Eurobonds that have been discussed in the newspapers a lot, and there's been a lot of news coverage on the Eurobonds. So what's your expert opinion with regards to the Eurobond discussion?
That's the inevitable question, I guess. It's a good question. it is to some extent an academic question, so a theoretical question, because really so for those who haven't followed this, Eurobonds, basically something that's proposed by, in particular, the Southern European governments as a solution to funding, some also the short term, but in the long term, a Marshall Plan for Europe, which would mean that every European, all EU members, or at least European Currency Union members, issue a bond together with shared liability. I'm saying this is an academic question because you would need to change all European contracts, not all of them, but of course the major ones, because that's something that's not part of the design of the European Union. Plus, we already have something in place that is essentially a Eurobond. We have the European Stability Mechanism and we have the European Investment Bank, right? The EIB is basically a bit simplified, the Europe equivalent of the KfW, right? So this is how European countries can get loans into the European economy. The EIB, there's provisions in place, just like the European Stability Mechanism, is essentially a Eurobond. There's strict rules, which is what the current debate is about. Southern European countries don't like the European Stability Mechanism much because they've, mostly with Greece, had the experience that this so-called Troika at the time, so the northern countries, look at certain provisions, covenants, rules that need to be in place and need to be kept by these countries. While the others, the Northern Europeans, say, well, if we allow a Eurobond, which means joint liability, this opens the floodgates to all sorts of moral hazard afterwards. What do I personally think? It's partly also academic because we de facto already have Eurobonds. So it is not something that can be done in the short run anyway. It's a midterm. And given we already have it, and the European Stability Mechanism that needs to be repurposed was built for the financial crisis, and the EIB, they have everything in place to act quickly. And that's exactly what's needed. And de facto, they are Eurobonds. So Northern European governments, in my opinion, could send the signal to Southern Europeans that they're generally open to Eurobonds. I think this kind of signal would be well appreciated by Southern European countries. And it would basically be recognizing a fact that these bonds, partly already in a well-designed environment, of course, already exist anyway.
Switching to another topic, some industries currently benefit from the corona crisis, like digital entertainment, esports, and so on. Do you also foresee problems for these sectors in terms of fundraising, for example?
I mean, right now, these are exactly the kind of sectors that could potentially sell equity and raise funds. I mean, in the debt market, even for those affected really really heavily and who are in a poor situation, the bond markets and also debt markets, with the exception maybe of the small business market, where still it's moving too slowly, but fundraising in terms of debt capital works. In terms of, so even for the very much affected, in terms of equity, these would be the kinds of firms that could now potentially, they don't need to, at least I haven't heard of one, that could raise equity because their stock prices are at record highs. They currently can sell a great growth story. The question in the mid to long run, of course, is, and that's what no one can really foresee, is whether this is going to be partly the new normal. And I think there's some indicators that, I mean, many of you, I guess, work in corporations that now work out of your home offices. So everything that's in the digital sphere will benefit significantly, I guess, mid to long run, because this will lead to significant changes in how we all work, how companies work. I've heard from a supervisory board head of a MDAX company the other week that he basically said the first thing in the next board meeting, once this is all over, I'll tell the CEO is to cut travel budgets by 10%. And they need to get it down by 25% over the next 4 to 5 years, because we see right now that this all works really well with Teams and other types of digital facilitators. So frankly, I don't see a big problem for these kinds of companies to get funding. both on the equity and the debt side. And of course, ultimately, their economic and fortune depends on how we as societies change the way we work. If it's just a temporary phenomenon, which I don't think is the case, but it's something that's more permanent, in which case they have a promise, high profitability, that should help them raise financing.
And how do you see the market retaking up speed per industry sector in general?
So I guess you're talking about the financial market. I mean, speed is something that's that's not the issue right now. Speed is extremely fast. It's even to the contrary. It's too speedy right now. But I guess you're referring to different industries that were hit really hard by the crisis to come back to pre-crisis profitability and valuation levels. How quickly? I mean, this again depends very much on, we're running in circles to some extent, that no one can really answer how quickly these lockdowns are gonna be reversed. And also again, the mid to long run, the first reaction was sheer panic. People are now getting much more rational about the implications. For example, you had hospital chains also being punished significantly in terms of downvalued by 30, 40, or even higher percentage points. They've already now gone back to pre-crisis levels. So the question again, how quickly will companies be able also to change their business model to a new normal? I guess the mid to long-term reaction for businesses will be that risk management becomes more important. So they buy insurance against these. You're absolutely right. Of course, pandemics, this is how we as humans work. As long as the problem is not as ubiquitous as it is now, we don't really act. And companies will certainly revisit their risk management with regards to pandemics and systemic risks in general. So the industries that find it easier to get back on track will react first. That's the obvious answer, right? And the question is a little bit on how long and how severely other industries so I personally see travel, air travel in particular, being restricted for fairly long, and if I get this as anecdotal evidence, also suffering in the long run profitability losses. So the question is whether they'll ever be able to return to pre-crisis valuation levels.
And another question for a bit of advice from you. So what do you think is the best hedging strategy for fund managers against the COVID-19 crisis? That's
another excellent question. There's no perfect hedge, as outlined earlier. So what would be typical? So basically, if every industry can get affected and also commodities get affected, the oil price plummeted, partly, of course, because Russia and Saudi Arabia couldn't agree on cuts in the amount of oil produced, but also because usage of oil, of course, declined. So commodities are not really a good hedge. So the one hedge basically has always been gold. But using gold really as a hedge is something where you need to take a very, very long-term horizon. It's by far not a perfect hedge, but it's the classic kind of totally unrelated to everything else hedge. I mean, some people have been discussing cryptocurrencies. I can't give you real advice about that because we haven't really seen how first cryptocurrencies themselves are extremely, extremely volatile. And to me personally, this sounds strange to have an extremely volatile asset act as a hedge. Secondly, we don't have any experience with these kinds of cryptocurrencies, because again, you need to look, if you want to hedge, you need to look to something that's totally unrelated to economic activity, because everything is affected here. So potentially, this is computer code running, right? It has nothing to do with shops being closed down. Could be a good hedge. Problem again, we haven't had much experience. The past crisis, huge crisis, which was different, but to this magnitude has been the financial crisis. Cryptocurrencies were non-existent at the time. So I can't give you good advice, but something along these lines, totally unrelated to economic activity.
And one last question, because we are running out of time already. Unfortunately, there's plenty of more questions, but I want to pose one last question. So what do you foresee well, after this crisis, how the risk management within organizations is going to change? Will this crisis affect risk management within corporations?
Another great question. As outlined earlier, absolutely, yes, I believe so. But not only in terms of these managing systemic risks, as mentioned earlier, but also in terms of supply chain risk. I think firms will move to multiple sourcing. So what many firms already in January, February in Europe, where the COVID crisis was not as severe as it is by now, we're facing is supply chain problems because China was closed down, no ships really leaving China, and being very dependent on a single supplier. This is a risk. Of course, every supply chain these days is highly optimized to the extent that we have even the smallest hiccup causing potential problems, but they worked. Global trade has skyrocketed over the past 20, 30 years. They worked really, really well. But now we're seeing that disruptions, what effects these disruptions to these supply chains can have. And if we move to multiple sourcing, it also means, of course, we are basically paying an insurance cost. So potentially that's something that, well, will lead to lower profitability, but that's where the risk management, in addition to managing systemic risks, will likely, in my opinion, lead so that you get more supply chain locally, so that global supply chain disruption does not affect you as strongly. And also, and we get back to Finance 101, the classic rule of not putting all your eggs into one basket, which is diversification also among suppliers.
So as we are running out of time, thank you very much, Christian, for the presentation and also for answering all the questions to all the participants. Thank you very much for participating in this webinar today and also for asking all kinds of very exciting questions. Unfortunately, time is running up and we cannot answer all of them, but we hope that this has been a good experience for all of you. And the last words go to you, Christian.
Thank you very much, Rebecca. So thanks also from my side. I see there's still many questions here in the Q&A. I see this as a sign of interest. So thanks a lot for your interest. I hope we could also interest you a little bit for WHU and our formats. So take a look at our executive education website. We'll have also the web, I think Ove Jensen, my colleague on sales, is going to be next week. So again, thanks a lot. I hope very much that we will emerge from this crisis with also learnings, not only costs in terms of recession, and all the best to you.